Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your business. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes, Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity and real estate funds, discussing developments and trends shaping the industry. These experts will share with you how they've leveraged the power of equity funding to grow their businesses and increase profits, and how you can too. And now, here's your host, Cliff Locks.
Welcome to the Private Equity Profits Podcast. I'm Cliff Locks, your host. And with me today is the senior advisor and shareholder at Delegate Advisors. Paul brings more than 30 years of experience in wealth management industry, working directly with clients' families. You've had the opportunity there and tremendous management expertise as the CEO and CIO of both single and multifamily offices, plus being in an investment committee at the Delegate Advisors. I'd say you've built a very successful career of consistently helping your clients. Tell me how you got started, Paul, and what led you to be an allocator.
I went to Stanford Business School. I was recruited by Bankers Trust, and I was on the institutional side. And it was a very fine firm, but I just wanted to have a more interpersonal relationship with the owners of the wealth. When you're advising and managing the money of pension funds and the like, endowments, you get to have interpersonal relationships with the staff, but it's not quite the same as several generations of one family that come to trust their advisor. While at Bankers Trust, I moved from the institutional side to the private bank of Bankers Trust, and that's where I got started. I was a portfolio manager.
Tell me a little bit about your investment process.
We invest at Delegate. We invest across all asset classes. We look at them all. We employ an endowment model. So there is nothing that can be invested in that we do not look at. Process, public or marketable side is usually quite much simpler because the information is there. But we look for alpha on private debt, private equity, and private real estate. And once a firm is looking at private investments, funds, and those sorts of things, I would say on the conservative side, it's 7 or 8 times, maybe 10 times more time spent, because when you give money to and it's illiquid in a manager's hands, you can't get it back when you want it. You can't just fire them, and you can't end your commitment short of some sort of lawsuit or something. The vast majority of our attention goes to the private side, private debt, private equity, private real estate.
Very good. What do you mean by patient but flexible capital?
I'll give you an example. Patient, firstly, we are going to allocate to managers that are locked up, which the shorter lockups on the hedge side, much longer ones on the private equity and private debt side. You need to know that, teach your clients that the returns, though, what are they giving up for giving up control of their money? And is it worthwhile? So that teaching ourselves as well as our clients to be patient, or that patience will open up new areas of investing where alpha, it's much more likely to be created. But it does require patient capital in that regard.
Very. What are you most proud of in your career to date?
Wow. First family that I had as a family office, I was the founding CIO of a firm. Being able to get involved with the family and set up things so that they would run well even when I was gone, a good replacement. Another family office that I started, a second one of the 2 that I founded. Second one, I think it was a very tech-oriented family. When the tech wreck occurred in the early aughts, having planned in such a way that left the family wealthy. Even after that, I think was the thing I'm proudest of.
Very, very positive. So you really had the foresight with the family to collaborate together to understand the risk tolerance that they had as a family.
You mentioned risk tolerance. That is probably, if you talk to guys like me, guys and gals like me, they'll tell you that is the hardest thing.
Okay.
People prior to some crisis, their risk tolerance is X, but it really isn't. It's half
Okay.
X. Those are the things that, but it's interesting you use the word collaborator. The second family office that I just mentioned, which was tech oriented, we struggled very hard to find a way to begin to diversify away from what was simply tech. Person was close to me personally, the family, prior to the wealth of the family. I was trusted, which I appreciated. Why would I, in many of our investments, the head of this family was a very famous investor.
Okay.
Why would I not use him? Of course, I was diversifying away the main source of wealth, but it was the person who'd be called one of the greatest investors of our generation, brilliant investor. The collaboration was very strong, and there was a great deal of trust there of our previous history prior to the wealth creation.
I think that's the magic word, is trust.
Yes.
It's the basis of all relationships at this point.
Being trustworthy is far more important than being brilliant, being even right most of the time. And best investors are only right most of the time. No one's right 100% of the time. But you're absolutely right. Trustworthiness is the most important thing. Why I was hired and why I was well compensated.
Okay.
The phrase that my business partner used is unrepeatable, but he just basically said, I know you will never take advantage of me. Translate into that hedge fund speak, and you'll know what I'm talking about. And mostly proud that everybody I've ever worked with knows that I put their interests first. When you are an RIA, you must be a fiduciary.
Very good. What is your approach to identifying risk factors that can lead to permanent impairment of capital?
That's a tough one. When we are dealing with managers who require locked up funds, that is because you can't just sell it today and receive, T+3 or whatever it is, the proceeds. I've always, when I've even talked about what the single most important thing went, and that would be private equity, private debt, and private real estate, is the manager. I have a belief, and I've not done the research on it or whatever, but my belief is that all risk reduces to general partner risk.
Okay.
And this will be interesting to your auditors, if you will, if they are private equity, private debt, or private real estate people. Everything reduces because they can choose to invest, they can decline to invest, they can add leverage, they can do any number of things. The single most important factor is general partner. Do they do what they say? And do they first say what they're going to do, and then do they do it? And every once in a while, you've got a good manager when that manager will come and say, this is what we said we were going to do. Okay. We have it. Here comes the flexibility part, but we stumbled on this tremendous opportunity, but it isn't what we said we were going to do. And in that regard, they say to you, you can opt out of this. We're going to form another LLC or LP that you can opt in. You don't have to. We know you signed up for this, our expertise, this we believe in, we're putting our own money. And that's when you begin to see, do they tell you what they're going to do, and then do they do it? That is the question to end. Interesting, but well, go ahead. And you mentioned about risks in general. Having something blow up on a manager isn't automatically disqualifying. During the underwriting process that they used to make said investment, what did they think was going to happen? They missed something, or was it force majeure of something? Or what did they miss? Then the question, it's not disqualifying because one asked the question then, what did you learn from that? How did this change your process? Process change. Have you? And I remember a hedged guy that I love this guy, and you saw these wonderful. It was asset-backed securities. You look at his monthlies, and you go, "What happened here?"
All right.
And the guy said, "Well, something happened that we will never do again," which is a brand new. The underlying. I'm old enough that it was securitizing receivables, medical receivables.
Okay.
And they thought they'd underwrite it, but it was the first issue ever to come, and this was decades ago.
Okay.
And then it sort of blew up on them, and what did they learn? They learned that they would never ever be first to try a new security, new flavor, whatever. They would need to stand back and watch it. Anyway, the answers were exactly what an allocator such as ourselves would want to hear. And once again, it all boils down to the general partner.
How do you achieve a holistic approach to wealth creation and management without the burden of sales pressure and conflicts of interest?
Well, there are always conflicts of interest, even in an allocator such as I have been all along. What is the conflict of interest? The interest is finite time. Okay. And so you go to, and this is almost all on the alternative side. You begin to, you look and you do your underwriting, you do really hard work, and it's great. And then you go, well, this is all done. And then the conflict of interest is the value of my time putting just as much effort in the monitoring of the manager, because you say, well, I'd like to move on. I know this gal or guy, this team is great, so I'm not going to re-underwrite them. There was it just went out of business for a lot of good reasons, not any disasters. They were a fund of hedge funds. I won't mention their name, but the thing that I most loved about them and tried to incorporate into allocating that I've done is they re-underwrite everything every year. And they start, would we invest today the way we invested 5 years ago when we went in? They've gone from 500 million to 5 billion. That should be re-underwritten.
That's gross. Wow.
It really so that the conflict of interest is the value of my time versus what our clients are paying us for. And you go, well, I look for something new. And I think we need to, in all fairness, we need to always re-underwrite, even if it's locked up.
Well, I think software, if you look at artificial intelligence and some of the data, the large data that's available to us, and I think at some point, the direct feeds, it could be from their bank accounts and from the client's bank accounts coming into an algorithm at this point and giving you a dashboard. So the underwriting may actually be something that continues to live and breathe. And that may be interesting to see how that plays.
Yeah, I think you have a good point.
I'm seeing that some of the banks are loaning money to the entrepreneurial community, and they actually are going into the bank account, watching, in my case, I'm on the board of directors, but watching the funds from Walmart paying, the company that I'm working with. They're loaning, hundreds of thousands of dollars based on the cash flow that's coming in on a weekly basis, based on consistent sales, but they know what's coming in. They see the receivables, they see the payments. Yeah. Now they have the visibility, they feel comfortable on lending. On a daily basis, they have access, and there's just an algorithm sitting behind it on the underwriting side of it. It's clean.
You touch on an interesting, being here in the Silicon Valley, you touch on an interesting point, which is entrepreneurs, and let's say that they are not yet managing partner of a successful firm. This is a gross overstatement, but the modal private venture capital person, private equity person here in this valley, the modal person is not the guy that's now the billionaire, the gal that's the billionaire. It is somebody that's a managing director. They live here in the most expensive housing in the world. And so they're Their net worth is about this. They're 10 million in property, in just where they're living, either a house in Tahoe or a house here in Atherton or Woodside. They have 10 million in very short-term bonds.
Okay.
Then they might have 30 to 40 million in their general partnership interest. Finding banks that lend to that,
Okay.
they go and come out of the business depending on what happened last year. So I once told an employer of mine when I was departing, said, goes, well, we really wanted, I said to him, all the time I worked here, you said you wanted to crack the code in Silicon Valley. I said, the code is cracked, but you don't want to lend to this person that has $10 million of property. You don't want to lend to them till they don't need to borrow anymore. And but they won't remember you fondly. The code is cracked. You just didn't like what the code said. I remember that was my final word to this most brilliant and wonderful president level of a company I worked for once. He was the best, but just didn't get that treasuring your balance sheet.
Excellent.
It has a downside if you're not willing to use the balance sheet for these wealth creators.
Well said. I salute you. Liquidity. Are you really liquid, or are you just looking good on paper at this point?
Yeah.
You got to service the debt.
The banks
with a smile.
They have to, but your point about the banks wanting, if they do lend on your general partnership interests, they'll want to know everything. You bank with them, they'll have visibility into your finances. In the warranties that you make, that you'll tell them anything that's happening before it's public and that sort of thing.
Very, very positive. Your firm's website says some of our best returns are often the result of independent thinking or conversations we have with our clients. Can you share examples of that?
I'll give you an example, and it's very common when a client comes to a firm like ours, depending on where they live and how they've been advised, they may indeed, we've had a client who shall remain nameless, of course, that brought about 120 single line items. This person was worth about 250 million.
Okay.
He had 125 line item private funds, private equity, private debt, private real estate. Okay. For a man worth that much, a family worth that much, most of those were $100,000 commitment. It's because they're known to be rich in their communities, and they would be somebody a manager would come to visit and really want to raise funds from a family like this. And most of them, I guess I could say during Passover, that most of it is dreck. It's just crap stuff, But every once in a while, one of our favorite, most successful managers on a number of fronts was one of those couple $100,000. And so because we are fiduciaries, we made it our job to get to know the different managers, if only a phone call. And at one, we just couldn't believe, almost by accident, they'd found one of the finest managers, private real estate, that we've ever used.
Very good.
And by the way, that same manager is the example I held in mind when they raised a fund. And then when they were very concentrated in this particular geography, their breath was taken away by this opportunity that presented itself. They came to us. We said, yeah, thank you for behaving correctly.
Very good.
We underwrote what they were doing. We thought it was good, and we went with it. And it has been a tremendous success. Underwritten, it involved hospitality. Okay. Their grand opening was last November 1st, in the middle of a pandemic, but they had so built in a margin of safety, to use an old investment term.
Very good.
They just went through, and it's proving to be the right place, the right time, the right project. Okay. But we found them that way, just accidentally, in onboarding a very good client of ours.
It's nice to see that you find real strong, brilliant individuals out there that are trustworthy. They're not over leveraged, and they're bringing deals to you that you can feel comfortable, that can be underwritten. The relationship you understand them, they understand your needs, the folks that you're putting money to work for. So I think it's a symbiotic type relationship, you know, and I think
It really is. And it's not every once in a while, not very often in my career, but I have seen where families have brought spectacular ideas to their advisor, their allocator, and say, what do you think about this? And it once again is that two-way street. It's a blessing when your family that is smart, open-minded, and wanting to learn, and then they bring you stuff, you bring them stuff.
Very good.
Very good.
Describe the culture and philosophy of your firm.
Characteristics of it. One, you mentioned to put the lion's share of our efforts into underwriting. We have, if I can just back up for a minute to tell you, firm, we use a custodian. We're custodian agnostic. We don't require we can warn off our clients to say we've dealt with these people before, they're terrible.
Very good.
But the bulk of our families use the custodian we'd prefer to use. They were experiencing a phenomenon of losing clients under three circumstances. One, they got very big.
Okay.
And they wanted to do-it-yourselfer and just got tired and said, I'm going to go. So if they went to someone that didn't have a relationship with its custodian, the custodian would lose that money. So, do-it-yourselfers who get tired, I think that's a big example. Other people that are attracted away. So this particular custodian began to assess the RIAs that used it.
Okay.
What was so remarkable, the head of marketing of the custodian said, we asked you what makes you good, any of all the different, it would be great client service, good investment returns. And he said, so we don't want you to tell us, we'll tell you, asked to interview us hours and hours, all our marketing materials, came away with three things they found we were excellent at. One was modeling. One of our chief person, the managing partner, CEO, is the finest modeler I've ever encountered. He started his career modeling Texas Bank balance sheets during the run-up to you might be too young to remember the savings and loan crisis. Fantastic modeler. Because some of our clients we weren't in existence and they didn't have good managers during the tech wreck, and the bulk of our clients, because of where this managing partner sits here in Silicon Valley, we have a lot of those people. And many of them were traumatized by the collapse of their tech share values and they do not want to give discretion to anybody ever again.
Interesting.
We don't require it. We like it, but we do not require it. And that makes us special. And then finally, what the custodian said we were good at was underwriting complicated deals.
Okay.
We did do that. We always do that. So those are the three things that I think jump out, are distinctive for the firm that I'm now an emeritus shareholder of.
Describe the process of not relying on historical data and trends and building individual models for the high net worth families that you work with.
So models, can you clarify what you mean by models? Are they?
Well, that would be your allocations at that point. In other words, the modeling, lay out a plan.
Right.
Historical data works in hindsight, but we're also looking forward to figure out where we think the markets are going at this point.
That's right. Firms such as ours, with the resources it has, we do annual projections for the capital markets, of course.
Very good.
And then we look at those quarterly also, and there can be oftentimes things that we did not see that are emerging trends that will affect an entire asset class. So we do it once a year, review it 3 other times a year. What we see is the capital markets outlook, really helpful to say in what we foresee happening, how is this manager behaved in what we see is happening right now? And the audience that I think that you intend, private real estate is a very interesting time right now, particularly with the central business district. Multifamily is not so badly affected. Central business district office, who knows?
Yeah.
Even retail, mixed use, all of those things are very interesting. When we were doing the planning in 2019, we did not foresee a global pandemic.
Very good.
So we were very conscious of a very major election taking place in the United States.
Yeah.
And we saw that and understood that, but we did not foresee a global pandemic. When that global pandemic strike, please God, not any more often than once every 100 years, you need to then say, how will this affect?
Right.
And that's just an extreme example. Things happen regulatorily, tax structures occur. There's always elusive fashion. There's fashion that needs to be understood and either embraced or avoided. I think it's that making projections, revisiting them as circumstances change, time passes.
Time test. I agree with that. I mean, and the confidence level, how confident do you feel on your different scenarios at this point in time, and the risk tolerance? And I love alpha when it comes to really understanding what we're doing. What do you love what you do, and what do you find most rewarding personally?
I think I'm a person whose highest value on interpersonal relationships in my life. Everything I do, both on my own time and work time with my family, church, all that kind of stuff, is the interpersonal relationships, because I think that's what we are created to achieve. I like that. There is a client that came to my firm because of me, and I worked with a partner at a major Final Four, I call them, timely now, Final Four accounting firm. He saw my work with one of his other clients. He was very anxious to come and have Delegate be the manager. And it took a while to prove, with once again that modeling more than anything, that we were the right firm. That guy and I now, we have lunch about every 2 weeks in the background here, and right up there on that terrace. And so that's been very rewarding. Financial officer for this family, which includes business as well as their personal. Gentleman and I have our wives, we've met each other's wives and have dinner together those are what's great about working with anybody, that wealthy families, the family's employees, partners, make it all worthwhile.
That leads me to ask, what will be your personal legacy?
I hope I'm thought of kindly by my clients and former clients. I've always been interested in mentoring young people. I was raised very poor. There really was no one white collar anywhere in my neighborhood or anything. High school history teacher said, it's pretty tough. Knew I was going to go to college. Of my 300 people in my high school graduating class, 6 of us went to a 4-year school. When you bring that viewpoint into a relationship, I think it's enriching. That my legacy, I think, would be of young people. For instance, I just recently was a judge for the CFA Institute, the Research Challenge is what I call it, and every year. And so they're given a company. This year it was First Republic, which is my bank, was asked to be in a panel to judge these 3 in a regional aspect. I could tell that who had, if I'm going to be crude, white collar people in their descended from white collar people, as those who didn't. I've also gone on a committee for diversity and inclusion in the local CFA society in our Western group that we've formed. What I'd like to see us do is reach out to people who don't have white collar people. In my family, I'm the guy that when the poor Hispanics are coming up, I'm their relative that has, quote, made good and has been on Wall Street, has an MBA and all that. So with my own family and the young people, I can help them. But I feel called to do that for people that want to get into my industry. They don't have clue one about finance, investing in securities, brokering, the investing in the issuing. They don't know how any of that works. So I guess that's what I'd like my legacy to be, is with the young people that I've tried to help, particularly those who like me, did not come from white-collar professional families.
I think that's very positive. I know when we look to mentor the youth, that is a legacy. I mean, it's not just family, but it's, we live in a community, an ecosystem, helping others to find sort of themselves and get exposed to opportunities that they could flourish, build wealth, help their family to continue to grow, and hopefully generationally they continue their legacies. I think it's a very positive way, to reflect on one's life at this point. I write checks, I have a young Black man that I'm working with at this point, and we're doing some development. We have a direct from farm to consumer. It's the Walmart. You and I were speaking about Walmart earlier. You can do it on this, the CEO of this company at this point, in watching him flourish. Now, he's a young 24-year-old man.
Wow.
Okay.
Good for him and good for you.
So, when you look at things, it's just somebody like yourself, Paul, or I, reaching out, having a conversation, through an intermediary many times, or it could be the high net worth individual who has children. And some certain children may be struggling and bringing them in, and they may not listen to the parents, but they may listen to Paul.
It's very interesting. We have a family that I would, if you will, we try to have two people to every relationship, at least on the advisory side, because you need backup and you need, two minds are better than one. And it was interesting. The just turned 18 grandson of the wealth creator, we're now mentoring him. It's delightful. And it's interesting why you need a multiplicity of people. One of my partners is saying, well, we'll chat with the dad. I go, the kid is 18.
Right.
And we'll need to ask him before we can just share with his dad. And so somebody had to say that. Sometimes it's other people saying that, but it's wonderful to see the young guy loves his father and respects him and everything. I just want to do this on my own, Dad. I want to learn at my own pace and my mistakes and everything. And his paternal grandfather gave him at 18 a low six-figure amount. And this is not grandfather, not our client. The grandfather who is our client just passed away in the fall. Unfortunately, I think with the young people, and this kid does have, if you will, wealth creators and everything, but in many ways, he's just as in need of instruction as a kid that I was when I was 18.
Our education in, let's say, K through 12, and then we go into the university. If you're not going into the finance side of it, you're not really getting exposed at all at this point. But at some point, we need to retire. You're going to need a nest egg. What we have on the retirement side is really a 401k, maybe a SEP, depending on what we're working on at this point. We can't rely on the government. The ability to articulate the fiduciary responsibility in the educational program, wealth creation, I think is key at this point.
Right.
And I think it's got to start at a young age, that it's okay to go out there, build something, build it with a great team, surround yourself with really, really bright people, try to overpay people a little bit, let the team stay together and to flourish together. Over time, I think the pendulum is going to swing back, because we really want to have something that's solid. Socialism doesn't work.
My own views deal over the years very much. I'm a believer in, I don't despise government, but I think we should try market-based before we determine that it's an externality best dealt with by a large central government.
Very well said.
Yeah.
Paul, can I share your contact information with our listeners? It would just be an email address.
Okay, let's use my personal email address, which is paul@perezam, that's PEREZAM.com. Thank you for this opportunity to speak.
My pleasure. Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. The show has been produced by Market Domination, LLC. Thank you.